Ben, we heard from Jay Pulaski of TPW Advisory talking about potentially this being an opportunity for investors, especially when it comes to thematic trends. I know that you're constructive in Chinese assets. What do you make of the latest?
Good morning. So for us at the BlackRock Investment Institute, the US-China tensions are structural in nature and are therefore going to persist. And that's going to be true for years to come, maybe even decades to come, almost regardless of who happens to be in the White House, for example. So the structural nature of the tensions are real. But actually, for us in 2022, we think we could see something of a lessening of the tensions, frankly, because both sides, both the US and China side, are so busy domestically. Clearly, very important political years, both in the US with the midterms in Q4, and similarly in China, a very important political year, as we all understand. So it seems to us that these tensions are going to persist, as I say, for years to come. That's kind of the mood music for the foreseeable future. However, in 22, actually, we think we could see something of a tempering just because both sides are so busy minding their own stores, as it were, with their domestic political calendars, where we think we'll see more focus.
So what do the domestic narratives in China mean for the markets? How positive and supportive could that be? We have seen the PBOC turn a little bit more easier on monetary policy, not to mention that fiscal measures perhaps seem to be a little bit more supportive lately.
I think so. So we at the BlackRock Investment Institute, we upgraded China equities to a small overweight, dipping our toes in on September the 27th. And we did that because we expected to see increasing signs of a broad-based loosening, not just monetary policy, RRR cuts, but fiscal, and critically, maybe a peaking in the intensity of some of the regulatory downdraft that we've seen. And so far, I think we've seen some more evidence in that direction. Clearly, we want to see more, but critically, over the last 10 days, Politburo meeting, economic work conference, I think kind of a huge deal, suggesting that indeed China has pivoted to a more supportive, growth-supportive policy mix, at least tactically, over the next 6 to 12 months. And for us, given how kind of bearish sentiment is towards China, Chinese equities in particular, that combination of quite bearish sentiment and a fundamentally important pivot towards tactically more growth-supportive policies from Chinese authorities, we think is constructive. So we remain overweight Chinese equities in our 2022 outlook and continue to be somewhat constructive, moderately overweight China equities for some of those reasons.
Ben, I'm assuming, though, you have to be pretty selective with that. There's not only regulatory downdraft, but I give you Exhibit A, Chinese real estate companies, Evergrande, Kaiser, now Shery. How long do you see these sorts of issues persisting in China's real estate sector?
I think, well, structurally, I think for a long time. I think one of the ambitions for China authorities is to create a more markets-driven pricing of risk. And to do that, you actually need to have some risk, which means the potential, at least, for haircuts and bankruptcy and so forth. If China can achieve that, it should lead to a differentiated cost of capital for companies with different prospects, which would be, I think, rather constructive in terms of the efficiency of the economy and the market and so forth. So it's going to be very interesting, clearly very delicate, and frankly, very hard for authorities. But if China can land the plane of simultaneously defending growth and keeping it high enough to support employment and social harmony, and kind of simultaneously inject risk pricing into markets, then that to me would be quite a constructive achievement, both temporarily, I guess, more of the short-term stimulus stuff, but more fundamentally, if China can move away from the implicit guarantee towards, at the margin, a greater reliance, I suppose, on markets to allocate capital. And as I say, to do that, you need to have risk. There's just no way around that. Then that would be actually strategically, over the medium term, an encouraging thing as China moves away from setting the price of risk by diktat towards more of a market-based pricing of risk and capital allocation model.
Is perhaps a less turbulent option Japan? I know you're bullish on Japanese equities, but how do valuations look for you there?
Japan looks, yeah, pretty attractive. We think valuations similarly seem relatively undemanding when we look at the equity risk premium that one can earn as a global investor. Japan is somewhat outstanding by some global peers, by comparison to some global peers. Japan should benefit from the, I guess, double tailwind of the global reopening. Of course, we're all watching Omicron very closely, of course, but it seems to us as if the activity restarts will continue to broaden through 22. And Japan, obviously, with a fantastic export sector, should have some gearing to that. And on the other hand, of course, Japan has got its own domestic activity restart, which again should kind of continue through 2022. So when we consider that and the potential for the new government to maybe do a bit more than was previously anticipated in terms of a bit of stimulus, a bit of reform, and so forth, then the valuation, to your question, Paul, valuation looks relatively undemanding set against the backdrop of those various potential catalysts that we could see start to play out in the months ahead.